Good morning, everyone, and welcome to the Prüm Group's Government's COVID-19 Town Hall webinar. My name is Ken Poon. I'm the moderator for today's webinar, and thank you for spending your valuable time with us this morning. Today, over the next 2 hours, I'm joined by 3 other partners at the firm, 2 reputable professionals in the industry, and 2 of my valuable clients to talk about how COVID-19 impact our state local governments. Coley Delaney, a partner at our San Diego office, has spent more than 15 years in public accounting and has audited many government of various size and complexity throughout California. The other partners, Frances Kuo, a partner at our Orange County office, has spent more than 16 years in local government's audit, and she's also served as the firm deputy QC partner. Vanessa Burke, a partner at our Walnut Creek office, has over 30 years of experience in public accounting. She has also held various executive leadership positions as both CFO and controller in government and private industry, where she has worked on financial restructuring, turnarounds, municipal bankruptcy, and distressed municipalities. Ken Deeker, one of our good friends here, is the founder and the principal of Del Real Advisors and has been in the industry for over 25 years, spanning and serving as a municipal advisor. He has served the city of Stockton as the interim debt manager and headed their debt team during the Chapter 9 bankruptcy. And he's also assisting the city of San Bernardino during the bankruptcy time. Mr. Jeff Chang, a partner at Best & Krieger, has worked in the employee benefit legal field for about 40 years. There are more than about 100 public agencies rely on Jeff for his guidance on benefit and retirement plans. We also have 2 others, 2 of my valuable clients, Onyx Jones, the Chief Financial Officer at the city of Culver City. Over the past 22 years, she has assisted companies and cities of various size to be successful in their financial operation. And last but not least, Kim Thorntner, the general manager at Olivenheim Municipal Water District. She's a licensed attorney in the state of California and is certified as a certified special district manager by the Special District Leadership Foundation. And thank you all for speaking today at our webinar. I'm sorry, the stroller is a little too sensitive here today. So today's agenda, what we are going through as COVID-19 come fast and furious. So what we are going to do is talk about how we are going to handle the 2020 audits, how we are going to conduct the audit, and how it is going to be accomplished. Also, as the federal government providing a lot of assistance, there will be a lot of grant opportunity, and then also in dealing with the administrative side, and then also the audit side. So what are the impact on COVID-19 relating to grants? So one of our partners, Frances Kuo, is going to talk about that. Also, will GASB relief, has any relief on standard that is currently being implemented? We'll go through those, and then we'll also, at the same time, we'll talk about some of the audit consideration and then financial reporting consideration for this upcoming year, or even for some of those clients that has not issued your June 30, 2019 audit or December 31st of 2019 audit. What are those impact to your financial statement? Vanessa Burke also will talk about the what government should take into account for in terms of revenue and cash shortfall. Like, this is really more practical when you comes into the mid-year revenue, like mid-year budget review, and then also preparing the upcoming year budget. That may be really helpful. Also, we will have Ken Deeker, who talk about the possible municipal bond stress and continued disclosure obligations. And Jeff Chang from BB&K will talk about the CARES Act and the retirements change during this COVID-19. And then the last but not least, the open forum, I'll ask both Onyx and Kim about some of the question, how are they going to see and what do they do during this COVID-19 timeframe? So Coley, how will the 2020 audits be conducted and accomplished?
Okay. Thanks, Ken. So as Ken mentioned, my name is Coley Delaney. I'm a partner with the Poon Group, and I'm going to be spending a few minutes today discussing some considerations on how the 2020 financial statement audits can be accomplished in light of the restrictions placed on all of us by the COVID pandemic. Right now, with the state on shelter-in-place orders indefinitely, our 2020 audits have begun to be affected and will continue to be affected for the foreseeable future. Typically, the spring and early summer is the time when, in normal years, we begin our planning and risk assessment stages of the audits or our interim fieldwork. But as most of you know, this typically results in auditors scheduling between a few days to a week or more, depending on the size and complexity of the audit, to be on site. During this time, we make inquiries of management and staff, review documents and files, evaluate, document, and test internal controls, perform preliminary analytics, and set expectations and make plans for the nature, timing, and extent of procedures that we would perform at year end. In the next few slides, I'm going to talk about how the pandemic will affect planning considerations, how interim fieldwork can be accomplished in light of these limitations and restrictions, how it will affect auditor risk assessments, and finally some financial reporting considerations for 2020 financial statements. Okay, so the first planning consideration is client staffing and availability. Some entities are fully staffed but closed to the public. Some have implemented furloughs. Some are doing work from home. Some are on a rotational basis. We've basically been seeing a bit of everything so far. So how are we going to be able to perform our 2020 audits, starting with interim fieldwork? The first option is on-site, right? This is the traditional method, but obviously this year some things will have to change. Will we face scheduling issues if auditing staff are rotating in and out of the office? Will key staff be on site during the auditor visit? If we are able to be on site, we need to make sure that key client staff are available as well. If key staff is on site, will the client staff actually have the time to deal with the audit and make the on-site audit time productive while they're possibly struggling just to keep up with their day-to-day activities? Like, for example, this could happen in a furlough situation where a person's trying to squeeze 5 days of work worth of work into a 4-day week. The number of auditors we send will potentially need to be limited due to physical limitations on conference room space available, since social distancing protocols will need to be maintained. Where we would previously have sent 3 or 4 people in a team before, we might have to limit that to 1 or 2. Another option is remote. Most clients don't have the capability to provide the auditors remote access to their accounting system and related files. And even when they do, the auditor still needs to consider the authenticity of scanned documents and whether evidence of internal controls exists and can be verified electronically. What about supporting documents that are maintained outside of the general ledger system, or sensitive documents like HR and payroll files or claims files? Some clients have these files stay in this room type of policy for things of that nature. Are you willing to provide this information electronically even though it contains sensitive information? Or are you willing to dedicate time and effort to scanning and uploading these documents? Probably not. Most likely, there will be some items that make it impossible for us to conduct a fully remote audit. So what we're most likely to see is that we won't be able to really do either the full on-site or the full remote methods. We won't be able to send a full team for the normally scheduled length of time because of virus restrictions, and clients may be unable or unwilling to provide all audit documentation remotely. In this case, we recommend a hybrid approach. With the hybrid approach, the interim fieldwork doesn't need to be locked into a specific scheduled week. Most of the necessary work can be done remotely beforehand. Initial document requests, which is our prepared by client items, have already been posted to our secure upload site, SureLink. So you can start uploading your documents now. You don't have to wait until scheduled fieldwork. As the client fulfills the initial document requests, subsequent auditor document requests will be made for specific items. So these would be documents needed for testing or for walkthroughs of internal controls, etc. And unlike when the auditors are on site, these document requests made remotely in advance do not need to have a same day or next day turnaround. The client can notify us when all the requested documents are ready for review. Then the auditors can come on site with a limited team for a limited time to review the documents that have been pulled and are ready for review. This hybrid method can help to spread out the time frame of interim fieldwork, making it easier on your staff, is making it safer for all the parties involved. So rather than everything getting done in a concentrated, pre-scheduled, dedicated week, for example, client staff can have more time to respond to inquiries and pull and scan documents, and they can just let us know when they're ready for us to send the team. And again, the team will most likely be limited to no more than 2 auditors in order to allow for proper social distancing from each other and from your staff. But they will only have to be on site to review documents that are already ready for them, and this will be the most efficient use of everyone's time. Okay, so next, here's some other planning considerations that can help to complete the 2020 audits. So scheduled calls and visits. It's good to have a weekly or more frequent call time set up so we can go over status and we can ask and answer questions in both directions. For on-site visits, let's make sure that we have confirmed that all the necessary documents have been pulled and are ready for review. Then we'll send a small team to review. Zoom meetings with screen share. I mean, we've all become much more familiar with Zoom meetings. Almost everyone has now participated in one or more. For some people, it feels like there's been nothing else besides Zoom meetings lately. However, these meetings don't always have to be scheduled in advance and don't always need to take a lot of time. We find this useful when the need arises to discuss specific documents or spreadsheets with clients. A meeting invite can be sent in the middle of a phone call or email conversation. And we can start sharing the screen, and so that way we're all on the same page. The client can provide auditors with read-only remote access. Read-only, it can be set up through VPN, remote desktop, Citrix, etc. We've done this with several systems like SAP or Munis or New World. It allows us to remotely run queries, review accounting records, and make testing selections, etc. Things that otherwise we would have to ask you or your staff for. We're also using DocuSign now. If people are not in the office to sign documents, we're using DocuSign for engagement letters, representation letters, things like that. Our firm also uses a system called SureLink, which is a secure document sharing site that we use for audit request fulfillment. It provides live updates on project status. It's secure for sensitive document upload, and user rights and access can also be defined in order to prevent sensitive information from being accessed by those who don't need to have access. Also this year, additional management representations will need to be obtained regarding subsequent events, risks and uncertainties and estimates related to the pandemic, but we'll get into that a little bit more in a few minutes. So whether we're able to conduct our interim fieldwork on-site, fully remotely, or in a hybrid fashion, one thing that will be affected this year will be our audit risk assessment. And one of the main effects on our risk assessments this year will be changes in a client's internal control structure. Some considerations for that are with remote workers or reduced or rotating staff. Has the client been able to continue to follow their policies and procedures? If not, have new mitigating controls been put in place? Have certain segregation of duties been removed as the client prioritizes keeping up with the work rather than following normal protocols? Are account reconciliations still being performed in a timely manner? When key internal controls consist of supervisor or management reviews, are supervisors and management able to keep up with them? Another one is, has an emergency been declared by your agency that provides certain positions with authority that they wouldn't normally have? For example, allowing sole source procurements, or council or board delegating additional approval authority to a city manager or a general manager. These are all things that will play into our audit risk assessments for the 2020 audits. And then we as auditors then need to be able to react to these changes in the internal control structure. So if internal controls have remained more or less in place, can we rely on testing of internal controls that has been performed in prior years? If internal controls changed for the partial fiscal year, are we still able to test and rely on those internal controls even though they've only been in place for a short time? If not, we will have to perform additional substantive testing during the year-end audit, which we're all currently hoping will not be materially affected by the pandemic. But at the Poon Group, for our 2020 audits, we are employing the use of artificial intelligence transactional analysis tools to supplement our ability to test internal controls and our use of normal substantive testing procedures. We're using an AI software called MindBridge and to import, analyze, and assign a risk score based on 28 control points to 100% of the client's general ledger transactions. So some of those control points that we're going to be looking out for software would be duplicate transactions, performing flow analysis, looking for manual journal entries, material values, rare account flows, reversals, adjustments, sequence gaps, things like that. This will fill in some gaps that cannot be covered in the traditional audit and may be necessary in order to respond to additional risk created by the COVID-19 environment. All right, some other risk assessment items for 2020 audits to consider are client estimates still reliable? Certain 2020 numbers will be vastly different from historical trends, like client estimates for receivables collectability and allowance for doubtful accounts, for example. Estimates for federal or state aid to be received will also need to be considered. Our auditor analytics is going to be unreliable. Again, historical ratio and trend analysis will be disrupted this year. Auditors might have to rely more on substantive testing procedures, especially for income statement items. As far as IT security issues are concerned, what additional risks is the entity facing with users working remotely outside of normal firewall? For inventory counts, will the auditors still be able to come on site and perform the inventory count? There'd be a potential scope limitation if we're unable to perform a count on a material balance of inventory, and a modified opinion might be necessary. The entities are facing increased fraud risks. This fraud risk increases with patchwork internal controls. Again, if reconciliations are not being performed in a timely manner, or if as urgency takes precedence over following established procedures. There will be effects on grants, which Francis will get into more in depth in the next section of this meeting. But for the single audit, will CARES funding be subject to the single audit? We don't know yet. Cities have already seen additional CDBG allocations. These things are going to potentially affect major program determination for your single audits in 2020. All right. Excellent. Okay. Financial reporting considerations. COVID-19 will also present financial reporting considerations for your 2020 audits. Revenue losses, sales taxes, charges for services, hotel tax, gas tax, etc., have been and will continue to be affected. Is the client able to secure short-term financing if necessary, or are client payables being delayed? Reductions in operations and services. Will it be necessary for reductions in operations and services, service cuts similar to what we saw in the 2008 recession, or will it go beyond that? What about receivables collections? Receivables, utilities, sales tax, etc. How are we going to calculate our allowance for doubtful accounts? Were deferrals of payments allowed? Are receipts of funding from state or federal sources to be received late? If so, what will be the effect on the measurable and available criteria for GASB 63 and 65 deferred inflows reporting? Fair value measurements in a time of high market volatility. How will items, especially those valued using level 3 inputs, be affected? Impairment of assets. Are any receivables or goodwill, long-lived assets, CIP, or intangible assets impaired because of the virus? Okay, aid received or receivable. Was the city awarded, or did the city receive federal or state, etc. aid, and was it awarded or received subsequent to year end? There will also be going concern evaluations. Will the entity be able to meet its obligations as they become due within 1 year of the date of financial statement issuance? Disclosure of subsequent events, and we have recognized versus non-recognized events. Recognized items, these are items that will be recorded in the financial statements, like an asset was impaired prior to the financial statement date, but there's also non-recognized items, so items that are not reflected in the financial statements, but should be disclosed, like does the entity's investment portfolio significantly decline after the reporting date, but before the report issuance date? Have developers or other borrowers that the city has long-term receivables from gone bankrupt subsequent to year-end, things like that. For December 31, 2019 financial statements, these would have COVID-19 effects as a subsequent event footnote disclosure. But for your June 30, 2020 financial statements, they will recognize certain effects of the pandemic in the financial statements and will disclose others as subsequent events in the footnotes. And finally, extraordinary items. So certain COVID-19 effects consist of losses that meet the criteria of unusual and infrequent in nature. And so these items for 2020 should be reported separately in the financial statements and include their own footnote. And so that's what I got. Back to you, Ken.
Great. Thank you so much, Coley, for sharing what your our idea how to accomplish this year audit. So the next item is going to how COVID-19 is impacting grants. As you know, the global devastation created the outbreak of the COVID-19, and there's increasing disruption stemming from the response to the disease continue to affect everyone's life in the unimaginable way. So the grant community is no exception. So Francis, how are we going to deal with the grant community here?
Good morning, everyone. My name is Francis Kuo. I'm also one of the partners of the Prune Group. So today I'm going to talk about how the COVID-19 is impacting the grant environment. So if you can move on to the next slide, Ken. So on March 27, the Congress and the President actually passed the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. So in that act, stimulus funding is actually being approved to provide more than $2 trillion to help business, individual, and healthcare state and municipalities. And within that $2 trillion that's provided, majority of a big portion of the funding is given to the individual taxpayer for the stimulus payment. And there's also $940 billion that's being used to fund grants and some of the loan programs. So there are several key federal programs that's being funded by the CARES Act. One of the big program is the Paycheck Protection Program, which include like $349 billion that's administered by the Small Business Administration to provide some of the loan guarantee program. And there's additional $10 billion that's being administered by the SBA for the Economic Injury and Disaster Loan Program. So these are the loan program that's provided to the small business in response to the COVID-19 pandemic. There are also other programs and grant funding that's being provided by the by the CARES Act. So there's about like $127 billion that's provided to Public Health and Social Service Emergency Fund, and $30.8 billion that's given to the educational purpose. Additional $5.4 billion for child care, family child care program, and then also the Children and Family Services grant programs. Also, there's $955 million for the aging and disability services and programs, and $900 million to provide funding for low-income home energy assistance program. And there's a $500 million over the 4 years period to provide telehealth and rural health programs. and $345 million for training and employment service program. So that's for some of the employment training service center that can provide development to provide training program for a local business and how they can react to the COVID-19. And additional $100 million to the state that had enact short-term compensation programs. In addition to the CARES Act, on March 22nd, 2020, the president also declared the severity and magnitude of the ongoing COVID-19 pandemic is sufficient to warrant a major declaration for the state of California. So there's additional FEMA funding that's given to California through the Public Assistance Program. So this program is providing funding for eligible applicants for costs related to emergency protective measure conducted as a result of the pandemic. So these assistance programs will provide funding related to management, control, and reduction of the threat to public health. So that includes the emergency operation center costs and costs related to training specific to the event, to the pandemic, and also disinfection of eligible public facilities. They also provide assistance for emergency medical care. So those cares are non-deferrable medical treatment of infected person in the shelter or in the temporary medical facilities, and also costs related to medical facility services and the supplies, and also the temporary medical facility, or to enhance the current medical hospital capacity. And can be also used for specialized medical equipment, medical waste disposal, and emergency medical transport. The funding also provides assistance to provide medical sheltering. So when the existing facility are anticipated to become overloaded in the near future and cannot accommodate the need, so funding will be provided to provide additional medical sheltering. So these assistance will be provided at the on the reimbursement basis. So FEMA will provide 75% of the reimbursement for the state and local government. And so because these are reimbursement basis type of grant program, so the recipient need to maintain a detailed listing of the eligible expenditures, and then these funding, these expenditure will be included in the SEFA, the Schedule of Expenditure of Federal Award, and will be included on the reimbursement basis. Also, this funding, FEMA will not duplicate the assistance that's being provided by the Department of Health and Human Services or other federal agency under the CARES Act. So you need to specifically include expenditure and identify which funding is being used to provide reimbursement for the programs. So in addition to the grants and the funding that's provided by the federal government, there's also administrative flexibility for the grant award recipient. So the Office of Management and Budget, the OMB, actually issued a couple of memorandum to provide administrative flexibility for the recipient. So the first one was issued on March 9th, that's memorandum M20-11, that's providing administrative relief for recipient of federal financial assistance directly impacted by COVID-19. This is more narrow in scope. So on the 19th of March, they provide and they actually release another memorandum, M-20-17, to provide additional flexibility that's similar to the previous one to expand the scope of recipient and in more detail. So that what they will do is they actually will review this temporary exception within 90 days. So which they will review the exception on June 19th to evaluate whether there will be additional or they need to remove some of the exceptions. So what that means is that under the for federal program that's funded, typically recipient need to follow the uniform guidance. So these memorandum actually provide some of the exception to the uniform guidance. So there are 13 uniform guidance flexibility that's being released from the M20-17 memorandum. So the first one is the flexibility with the SAM's registration. So the OMB actually allowing the awarding agency to relax the requirement for active SAM registration in order to expeditiously issue funding. And number two is to give flexibility with the application deadline. So the awarding agency can provide more flexibility in terms of when to complete the application as for the competing application, as well as the unsolicited applications. So what they are requiring the awarding agency to do is to provide a list of specific guidance on their website and then the contact person, so that the grant applicant can actually go onto the website and then contact the person to get more information about the extended deadline for the to apply for the grant program. And number three is to provide waiver for notice of funding opportunity publication. So typically there's a specific time frame that they have to notice the award. So the memorandum actually give the awarding agency let the awarding agency to publish emergency notice of funding opportunity for less than 30 days without separately justifying the shortened time frame. Number four is to provide no cost extension on expiring award. So the awarding agency also may extend the active award that as of March 31st of 2020 and scheduled to expire before end of the year, automatically at no cost for a period up to 12 months. And the project-specific financial and performance report will also have some extension, which will be 90 days following the end date of the extension. Number five is the abbreviated non-competitive continuation request. So the continuation request that will become due between April 1st to December 31st for the project with a planned future support. So the awarding agency will also accept the abbreviated statement. So to allow the recipient to submit the statement to say that, okay, they will verify they will resume and restore their project activity and accept the planned continuation award. So that would give them, so they will spend less time to reapply for the continuation of the project. Instead, they will just continue with the program. So number 6 and 7 are both related to the cost incurred for under the federal program. So number 6 is allowability of salary and other project activities. So these are related to the salary and benefit to the current federal program. So they can continue to charge cost related to the salary and the benefit. And number 7 is related to the cost that normally would be chargeable to the award. For example, there are some costs related to cancellation of the event, to travel or other activities that's necessary for performance of the award, and work related to the activity that's been paused and had to restart because of the public health emergency. So the memorandum is actually allowing certain costs to be able to be charged to the federal program. But the awarding agency must require the recipient to maintain the appropriate record and cost documentation to substantiate those costs related to the interrupted operation and services. So the grant recipient need to actually maintain those records on what kind of costs are incurred even during the pandemic to continue the program. Number 8 is related to the prior approval requirement waiver. So typically you have to request approval in order for certain costs. And so this waiver actually allowed the awarding agency to waive the prior approval requirement as necessary to address the response. But the cost that's incurred still need to follow the federal cost guideline. Number 9 is the exemption of certain procurement requirement. So the awarding agency may also waive certain procurement requirements regarding the geographic preferences and also contracting with small and minority business, women's business enterprise, and other labor surplus area firms. Number 10 is provide extension of financial performance in other reporting. So they are giving a 3-month extension beyond the normal due date. So the awarding agency will allow the grantee to delay submission of these financial performance or other reports. Number 11, related to the indirect cost rate. So there's also additional extension on the indirect cost rate. So there will be additional 1-year extension to continue to use the current indirect cost rate. So that's it, if the agency is also finalizing the submission of the current indirect cost rate, that's for future time, then there's also extension allowed for that. Number 12 is the extension of the closeout. So the agency, the recipient, are also given a 1-year extension to complete the closeout reporting. So the delay cannot be over 1 year after the award expired. So those will include a financial report, performance report, and other report for the closeout of the project. Number 13 is the extension of the single audit submission. So for typically the single audit is due to the Federal Audit Clearinghouse. So either by March 30th, after 9 months of the close of year end, which for most clients will be by March 31st of 2020, or 30 days after the report's issue. So they have to report and then submit the data collection form to the Federal Audit Clearinghouse, and then also complete the audit. So there's this extension for the single audit submission for single audit that has not been submitted to the Federal Audit Clearinghouse as of March 19 and through next fiscal year, June 30 of 2020, to delay the submission for another 6 months. So all the recipient of the federal award will have additional 6 months to complete the audit. And there's no further action that's needed by the awarding agency to enact the extension. So there's no approval that for the recipient to get to seek extension, but the recipient should maintain documentation for the reason on the delay filing. So even though you are not required to get extension request, but but there's got to be some documentation on your end to document that, okay, because of the COVID-19, because of the closure of the city hall, etc., that there will be delay in the filing of the data collection form to Federal Audit Clearinghouse. And because of this memorandum, so the recipient or the subrecipient can still qualify as a low-risk auditee for the next year's single audit. So typically, if the single audit is not submitted to Federal Audit Clearinghouse before the deadline, then automatically you will not be qualified as a low-risk auditee. So if the only exception to be assessed as a low-risk auditee is due to the late filing, then the recipient can continue to be qualified as a low-risk auditee for the next single audit. So these are the couple key areas related to the grant and the impact of the COVID-19 on the grant recipient. And we will continue to monitor any future development of the grants, and then we will definitely let everyone know if there's any future development that will impact the grant environment.
Thank you, Francis. And what we are going next is, so now we're dealing finishing up the grant community. What about financial reporting? As you may be aware, GASB also, there are a lot of firms and even government officials actually calling GASB and say, hey, is there any extension? Because as you know, there are two big statement, GASB statement number 84 and GASB statement number 87, one on fiduciary activities and 87 dealing with leases. It needs a lot of information and needs to pull a lot of information internally. And given the the current closure of the city hall and people are not be able to get into the office, will Gatsby actually provide some sort of relief on the standard being implemented? So basically, back in March of 2020, March 26, Gatsby actually added one project to the current technical agenda and considering postpone all the statement and implementation guide with an effective date that's begin on or after reporting periods beginning after June 15, 2018 by 1 year. So what we are going to see, take a look at the original, the in scope effective date. As you know, for June 30, 2020, there are two statements, including 84 on fiduciary activities, and then statement number 90 on majority equity interest, and then along with the two implementation guide needs to be implemented during this fiscal year. Health Society CPA of the Governmental Accounting and Auditing Committee also issue a white paper prior to the Gatsby adding to this agenda to talk about some of the unique situation, California-specific situation in dealing with 84, and also we issue a white paper on March 31st of 2020 to talk about the implementation. So 2020, we have all these two statements plus the implementation guide, and then 2021, that's the big one, 87 on leases, 89 on interest costs incurred before the end of the construction period, 92 on omnibus 2020, and then 93 replacement of interbank offer rate, and then another implementation guide on leases, and then in 2022, statement 91 on the conduit debt obligation. So this is really my first time in my life, in my career life, to see Gatsby really provide some sort of relief and talking about postponement of the effective date of the Gatsby pronouncement. So what the exposure draft, the exposure draft was actually issued on April 15 of this year. And with a really short comment period, it only is given about like the 15 days period for people to comment, which is one of the shortest one that we see. Potential of proposing of the effective date by 1 year. We are expecting the statement will be issued by May 8th of this year, and then also early application is still encouraged. As you're aware, this is still in an exposure draft and it's not approved by Gatsby yet. So basically, as if it were not approved, we are still following the previous schedule on implementing the 84 during this year, 87 in the next year. So it's kind of going through that. So, but my gut feeling is Gatsby is actually looking at this exposure draft really carefully and consider all the factor that people are facing right now, all the challenges that they are facing right now. So I'm still seeing this as a great potential of delaying the implementation by 1 year. But does that mean that you basically stop doing anything now and just waiting for another year? No, you basically will keep going and not even piecemeal to implement your statement, because either you implement it or you are not implementing it. Instead of like, oh, why don't we just do, like, especially on Gatsby 84, why don't we just change the agency fund to custodial fund, and without looking at the rest of the provision regarding the pension and OPEB? No, you really need to implement it, either all of them or none of them. So don't piecemeal implementing any standard, okay? The possible outcome in the exposure draft, they actually list out like a list of all the statement, as you see in your screen right now, all the way from 83, 84, and all the way up to 93, paragraph 13 and 14. statement number 93 also, like the Gatsby, prior to the issuance of Gatsby statement number 93, they already consider on all the factors that will be impacted by COVID-19. However, paragraph 13 and 14, those will need a little bit more time to implement it. So they will consider these two paragraphs will be postponed by 1 year. And then also the next slide, what you can see is the implementation guide. They will also be put in the exposure draft. That will be also recommend to postpone by 1 year. So any additional from Gatsby, as you know, Gatsby never rests, and they also issued the Gatsby statement number 94 on public-private and public-public partnerships and the availability payment arrangement. It was issued back in March of 2020. This was not included in the exposure draft as one of the statements that is proposed to postpone by 1 year. So it's already considered this 1 year. So the effective date for this statement is for the fiscal year end, fiscal year beginning after June 15 of 2022 and all reporting period thereafter. There's also another one exposure draft that is under the current technical agenda for Gatsby is certain components unit criteria and the accounting and financial reporting for sections 457 plan. As you're aware, when Gatsby looking at 84, there's still a little bit concerned on how we determine the components, the fiduciary components unit, and based on the components unit criteria, Gatsby also put into an agenda item to relook at the criteria and issue a new exposure draft for on this area. So as Coley said earlier in our early presentation here, the COVID-19 may affect the financial reporting. It may impact your fair value measurement of investment in the time of high market volatility. One of the things that you may need to consider is all the risk disclosure that you have in your cash and investment footnotes, not only about the fair value measurement, but all the credit rating, the custodial risk disclosure. Those are the things that may have an impact on your financial reporting during the upcoming fiscal year end, June 30, 2020. You also need to think about any potential impairment on any financial asset that you have and the hedging strategy. Because remember, back in the housing crisis, the Lehman Brothers, there's a lot of impairments on those investments. So you may need to coordinate with your financial advisors and determine whether those impairments will have an impact to your financial statement. The other thing is relating to the pension and other OPEB and the OPEB plans. The pension and OPEBs heavily relying on the expected long-term rate of return when it determines the discount rate. So during this measurement period, so what you need to look at is, will the investment within your pension asset and OPEB asset be impaired and will impact your valuation during this valuation period. And currently, I highly recommend you working with your actuary and then also talking to the investment plan and make sure that there are nothing impact to your to the investment and may determine to needs to lower your discount rate. The other thing what you may need to look at is the liquidity and cash flow risk. One of the area that we look at is the going concern, which I will talk about that in my later slide. And how is that going to impact your current operations? Is the auditor ourselves having a substantial doubt about your going concern as a government? moving forward. So the liquidity and the cash flow risk, one of the area that we focusing on is how, like, especially the general fund. We look at the, and also your a major enterprise, like the business type activities. Do we need substantial subsidy from the general fund to subsidize during this pandemic time? Other accounting estimate and debt service payment, that's probably another area that we look at during this financial reporting period. Let's kind of dig a little deeper into the subsequent event, both either for some of the agency, you may not necessarily be reported, may not necessarily be issued during this time of the year, and you're still wrapping it up your financial statements. So making sure that you describe your subsequent event for COVID-19. The California Governmental Accounting and Auditing Committee actually issued a government industry alert a couple days ago to talk about the subsequent event footnote, and then provide you some of the sample footnote disclosure in this document. So both either recognize subsequent event, that means the events provide additional evidence about the condition, such as bankruptcy or pending litigation that exists at the balance sheet date. The effect of this event generally needs to be recorded directly in the financial statement. However, majority of one of the event that is, because this is a natural disaster at the balance sheet date, we are not be able to estimate or provide any information during this this event. So basically, a disclosure in the footnote providing the information will be legit. So that's why adding a subsequent event footnote to talk about the nature of the event, and also an estimate of its financial effect is also appropriate. So going concern, as you may aware that the going assumption is the basic underlying assumption of accounting. For the government to be a going concern, it must be able to continue operating long enough to carry out its commitment, obligation, objectives, and so on. So GASB statement number 56 provide the following indicator that may raise significant doubt about the government's ability to continue as a going concern. So the first one is really talking about the negative trends, recurring periods in which expenses or expenditures significantly exceed revenue, recurring unsubsidized operating loss in business type activities, consistent working capital deficiency, continuing negative operating cash flows from the business type activities, or adverse key financial ratio. So those are areas that we looked at. The other indication of possible financial difficulties include defaults on bonds, loans or similar agreements, proximity to debt and tax limitation, denial of usual trade credit from supplier, restructuring of debt other than refunding, non-compliance with statutory capital or reserve requirements, or the needs to seek new source or method of financing or to dispose of substantial asset. Some other internal matters, including work stoppage or other labor difficulties, substantial dependence on the success of a particular projects or programs, on economic long-term commitment, burdensome labor contract, for example, or the needs to significantly revise operations, or maybe by other external matter, including legal proceeding, legislation, or similar matters that may jeopardize intergovernmental revenue and the fiscal sustainability of key governmental programs, loss of critical license or patents for business type activities, loss of principal customer, taxpayer or supplier, or uninsured or underinsured catastrophic, such as drought, earthquake, or flood in this situation. In addition, Gatsby also issued an emergency toolbox to help stakeholders to quickly identify the Gatsby authoritative guidance that could have a could be relevant to the current circumstances. So disclosure including like contingency, capital asset impairments, going concern, those will be all included in this one great toolbox. And in my presentation here, you can see the link to the toolbox that will be really helpful to financial statement preparer. So the next topic is going to Vanessa. Vanessa, what government should consider in terms of revenue and cash shortfall? How are they going to prepare this to adjust their current budget, or how are they going to deal with the upcoming 2021 budget season?
I'm based in Northern California. I did see the list of attendees. Shout out to some of my clients on there as well as non-clients. It's really an honor to be here in front of all of you. This is a super smart group of people that are on this call. Ken mentioned earlier, I've got about 30 years of experience, so I've weathered a few fiscal cycles in my life. One of probably the most significant was when I joined City of Stockton back in 2011 during the Great Recession, and was able to sit in the seat of the Chief Financial Officer and take that city through its bankruptcy proceedings for both the eligibility trial as well as confirmation of the plan. And I'll be followed by Ken Deeker, who also assisted during that time frame. So I guess one of the things to say is really this too shall pass. I know you're all dealing with a lot in your lives right now. And some of this is what I'll be talking about is uncertain. But what I can tell you is you will get through it. And I hope at the outcome of this presentation, I'll give you some tips. Next slide, Ken. I forgot to start my timer. So really my objectives for this topic are to talk about kind of the major revenue streams that most cities have and what the impacts of COVID-19 have been on those, as well as talk a little bit about some options that are available to you as you're looking at your mid-year budgets and planning for next year. I'm also going to talk about the importance of cash flow. Ken talked about it from the concept of going concern. The concept for bankruptcy is significantly different than for going concern. It's really looking at kind of a three-legged stool, which means, you know, one, are you a municipality? Two, are you budgetarily insolvent? And three, service level insolvent feeds into that, as well as are you cash insolvent, which means are you not able to pay your debts when they become due. And so I'll share a few tools with you on that, as well as talk about the importance of monitoring your cash flow and how often projecting cash flow and opportunities to respond to cash flow. Next slide. So I think most of us have some elements. Not everybody has an airline or an airport, but there may be some cities on here that do. But I think what's really the most important in terms of the revenue stream is realizing that there are going to be pretty significant and huge shortfalls in various areas. The League of California Cities, maybe you all have participated or some have participated in their webinars. They're looking at a revenue shortfall of around $7 billion overall to the general revenue in the next 2 fiscal years. If the shelter-in-place orders extend into the summer months and beyond, that shortfall will grow by billions of dollars. And really, I think everybody, regardless of size and geography, are going to be impacted, and specifically those that have sales tax or sales tax measure driven revenue streams, as well as transit occupancy tax, are going to see some pretty substantial impacts. As you can see on this slide, I put tourism-based economies first. Really, your TOT is impacted, your sales and use tax is going to be impacted from related business, as well as you're going to have business operations tax, or what we would call our business licensing tax, as well as concerts and entertainment venues that are going to be impacted. I have a client in Arizona, 78% of their general fund revenue, it's a whole different market, comes from sales tax, and they are very heavily tourism based. And so we're going to see substantial impacts there. I think we all know traditional retail sales or auto sales as well. I'm going to throw auto sales in there. Those are going to be significantly impacted with this, as well as building industry, appliance, as consumers during this last 2 months have really shifted from in-store buying to online. So we know it's going to affect sales and use tax, your business operation tax, as well as your transaction and use tax. And on the business operations tax, we'll talk about this in a little bit. You know, essentially, all of us probably know of friends, family, close colleagues that have businesses in retail that are suffering from the shelter in place and likely may end up in a situation in which they're going to contract their business or close their businesses. I think also from the service standpoint, you know, cities, we know they're in this survey that 79 to 90% of public service is either going to be decreased or cut in all likelihood based on where we're at now. So you also, as providing services to the public, will probably see some impacts. Food industry, bars and restaurants, we know impacts to sales tax, takeout food is taxed, groceries is not taxed. So we're going to see a shift or substantial shift there. A lot of us are doing curbside pickup. We know transaction and use tax affected, as well as business license tax. With food industry, we see some substantial businesses that have been out there, mom and pop stores that are likely not going to be able to weather the storm. Airlines and airports aren't flying as many passengers. If you have an airport, your passenger facility charges are going to be impacted. I saw a picture of car rentals, which, you know, we all get some tax off of that, and service charge. And I saw a picture of the Sacramento airport, and the lots were overflowing. It was an overhead picture. So we know that car rentals are going to have an impact substantially because of the lack of tourism, the lack of business travel, conferences, and things like that. Transportation industry, we know fuel is at an all-time low. Vehicle sales is projected to drop by about 80%. We think that, you know, obviously we'll see a recovery, but I don't believe until consumer confidence comes back that that's going to be anytime soon. And many of you are dependent on vehicle sales within your region for your sales tax, as well as fuel prices being at an all-time low, and taxation is going to affect your HUDA and local streets and road allocations. Grant funding, obviously, Francis talked about increasing in grant funding. We know that that's going to happen. There may be some increased compliance there, as well as you may see some decreases in your reimbursement because you need to delay projects and things like that. So, you know, it could be, they could be running in sync with each other. Overall, I think cities will also see, they're projecting that they're going to see that their policing services will be adversely impacted. Please remember, some of your sales tax measures do support police. And so if you're going to see a decrease in sales tax, you may also see a decrease in your measures. Next slide. Sales and use tax. We talked about that, but in general, the governor has essentially allowed a deferred time frame for payment of the sales tax by individual businesses for automatic 3-month extension, as well as waiver of interest and penalties. We see that we anticipate there's going to be a reduction of the advances that you're paid, as well as the true up after year end due to the drop in sales. Looking at what HDL said, they believe this is going to continue through 2021 and then level off maybe at about 1.5% decrease. First quarter, we've got about 7.5% decrease. Second quarter, 36.1%. And overall for the year, luckily we had a good beginning of the year, 9.5%. And this is if we can get through this shelter in place that is pushing consumer spending to online sales. So you're going to see some changes in your budget because of that. Property taxes, there is an impact on the housing market. We are not going to see that because assessed values take time to show up in the assessment rolls, payments, as well as revenue. That will likely hit your budget. So these, I'm saying, are short and long-term impacts. You've got to be thinking not only short-term preserving cash, but long-term for the impacts to come. Not until 21, 22 is when we anticipate those will show up. I do know that in some cases, new home construction is halted. There have been substantial layoffs in the building industry for new home builders. I do know that in some cases, some of the large developers are not pouring new foundations. And I know they deem this as an essential business, but I think people's confidence is a little hurt at this time, and so they're not moving necessarily. So correspondingly and ratably, you're going to see development impact fees that are going to be impacted with a drop in your construction and your permits. We went through business licenses a little bit. California is going to reopen in a phased approach. I'm not sure that some of those businesses can reopen in a 4-phased approach. And I know some of that is based on contact tracing. And I don't believe that the state is set up to do that yet. We talked about permit fees. I want you to think in terms of your cities that fewer are driving. So your parking meters are going to be impacted. Your parking garages, as well as your parking tickets, are going to be impacted. Park and rec fees, rentals, auxiliary service fees, theaters, convention centers, sports and health. I know it sounds so overwhelming, and I can appreciate the job that you're all doing in trying to get a handle on this. But each of those charges for services could have a substantial impact. In utilities, I talked with one of the cities on the call here on water, sewer, solid waste. As you know, Newsom has ordered a waiver of interest and penalties, and you cannot shut off services for non-payment by customers. I think what we know is that many of the counties are on the teeter plan, and leaning is an opportunity for you to take a look at leaning if you haven't done that in the past on property taxes for that. Next slide. Other things to consider, unemployment rate. When we went into the Stockton bankruptcy, unemployment throughout the country was at an all-time high. When we filed for bankruptcy, we were around 22 to 23%. LA County has come out expecting to be at 30% or higher after the May release. The numbers that are here right now are, prior to COVID, our unemployment rate as a country was at an all-time historical low since the 70s. We do know based on the March numbers that there was a rise of 1.4% in California's unemployment rate to 5.3%. That's the largest unemployment rate increase on record since 1976. But they're currently projecting at the state that the unemployment rate at the end of July, once we get our numbers in, is going to be about 15.6%, so the 19th highest. April numbers, which include through middle of last month, is scheduled for release at the end of this month, so it's delayed. I want to brace you for some bad news. We do know that another 3.84 million workers filed for unemployment benefits, and we're surpassing 30 million nationwide. And we're having trouble with our unemployment funds in the U.S. going broke from the record flood of claims. California, one of those, borrowing in order to pay those claims. Next slide. I know I'm a ray of sunshine today. Other things I'd like you to think about in your revenue is your operating reserves. Have the levels been sufficient already to cover your rising cost of pension? And OPEB Ken talked about that earlier, as well as operating reserves. We know many governments were just coming out of the Great Recession and starting to realize the impacts of the increasing cost of pension because of CalPERS's reduction in the discount rate, and also GASB 74 and 75 putting OPEB on the books. So if you're starting to burn through those reserve levels at a different clip than what you were doing before, because of COVID, you got to keep in mind you've got these long-term obligations that are out there. Also, the stock market has reacted as expected, meaning it has dropped, and that's going to impact the value of assets in the pension plans. That impact is going to take 2 years to appear in the actuarial valuation, so unfunded obligations could also increase because of the decline in the assets being held. I think we had 2 good years of stock market returns. It was still, if you were to look at CalPERS, was not enough, and not enough to make up the whole. So I think we're going to see something big happen there as well. So you should be forecasting the impact to your reserves, and is there sufficient liquidity to support it? From a budget perspective, I would be looking out not only at the next year, but probably 2 years out, because some of this is long-term. Also considering in the last 3 to 4 or 5 years since we got out of our municipal bankruptcies and moved into a period of boom or a boom economy, many labor agreements, we started giving COLAs because we hadn't for a number of years given COLAs to any of our bargaining agreements. So those are going to have a substantial impact to your budgets. We got to look at COVID, and then as well, look at all of your ability to pay all your contracted obligations when due. So if you don't have a good handle on all of your commitments from a contractual basis, I would take the time to do an inventory of all contracts and get a contracts management database in time. Also look at what you're doing with one-time monies. Are you using those to fix structural imbalances this year? If you are, those may not be available to you next year. And then one of the things in Stockton's bankruptcy we did is we took a look at fund deficits as well as cash deficits and other special revenue funds, and whether or not the general fund may need to absorb those costs. Next slide, Ken. So keep in mind from a revenue perspective, how long will this continue? I don't know that any of us know, but think about, will there be a second wave? Is it possible? And I've heard it could be worse with flu season in the fall. How will the business and the economy respond to the new normal? Are you going to be remote workforce for some of your individuals that could save you money? Are you going to close leases down where you're leasing office space for workforce that could be working from home now that you're in this environment and accepting the fact that we are able to have a remote workforce and stay in business? And are you going to need to adapt technologies for the transition to the future? Cybersecurity being at the top of that list. It's not part of our presentation. I will tell you there was a breach last week in a major city. And I don't know if it's COVID related, but it could happen. So there may be investments that need to be made to secure a more dispersed workforce, as well as enhanced communication among your teams. Next slide. So for revenue and looking at your budgeted revenue and costs, internal borrowing from your pooled cash is possible if it can be paid back before the end of the year, if it's from restricted funds. If it can't, or if it can't shortly thereafter, I would suggest that's probably not your best option or even an option. You need to assess that an implied internal borrowing hasn't already occurred. Do you have cash deficits already in your general fund that need to be filled, or in other funds within the pool? So I always took a look at all funds, current month, prior month, and how those changed from month to month, and split them between restricted and unrestricted cash. It was very important to see also that possibly we had pockets of unrestricted cash that existed within restricted funds that could be used for a one-time transfer to help fill your hole. I have heard many are considering short-term borrowings to cover tax delays with trans and rands. We know those were used significantly back in the 80s, but generally those have to be paid back before the end of the year. So it could get you some bridge period of time, but not forever or the next 2 years. You can look at delaying or eliminating expenses, furloughs, layoffs, contracts, you know the list. And then any new compensation that you've committed, and I won't take Jeff's slides away from him, but they could trigger a meet and confer process. And then I would say more than anything, you need to have a heavy focus on your cash collections. A lot of people don't pay attention to cash. Cash is pretty much necessary, and we'll move to that in the next slide. As well, I would say, be honest with yourself about your receivables. This is the time to decide if they're really collectible. So let's talk about preparing cash flows forecast in uncertain times. And I know people have said this forever, cash is king. It's always king. I would say during a financial crisis, it's likely an emperor, because you're having to manage, and that management may need that you need to monitor cash on a daily basis. As we were leading up to the bankruptcy in Stockton, I had several reports I used. One was a daily projection of cash. We would look at all deposits that came in the night before. We would look at all cash needed within that next month, as well as future months. And we based those on projections and trends in prior months. And that was really crucial to ensure that we had cash on hand for essential services. And when we realized we were going to run out, we ended up filing for Chapter 9 protection. And that's important because it not only protects the officers, but protects you against litigation. When taking a look at available cash, one of the things you need to realize is that not all cash is the same. Not all is liquid within a short period of time. I would include cash conversion, so AR, as well as looking at a laddered approach to that. So some of your CDs may not be maturing for some time. And so you need to look at the laddering of your cash within your portfolio. So it's not just that pooled cash line, it's that pooled cash line split between those that could be available. And you need to be monitoring this on not only a daily, weekly, monthly, quarterly, annual basis. Last, I'd say keep the model simple. Simple enough to understand. There's lots of companies that'll sell you software. I don't think it needs to be that complicated. Plus, you need to be able to explain it to stakeholders. Next. Cash is king. Risks with cash flow. The first and foremost is that your cash flow analysis is only as good as the underlying data used. I can tell you, we said this 100 times, we needed to work on getting our fiscal house in order first. If you aren't closing, if you aren't getting your major and significant expenses posted timely, if you're not reconciling, your cash flow may not be what it needs to be. And you may end up with surprises that you don't want to have. So you've got to get your physical house in order first. And you can see that you may have unintended borrowings from restricted funds, or you may see that you double borrowed for one project and used two sources of funds for paying for one set of costs that now has to be repaid. Several things can come to light. As well, one of the things with it is that structural deficits may be identified, but action isn't taken at the council level or by city managers, and you're going to continue to burn through reserves with that. If they aren't resolved timely and cuts aren't done quick enough and you're just waiting to get your fiscal house in order, it may not be time. You may not have enough time. And then the last is, I want you to think about those reserves, contingent and rainy day funds. Those may not be enough if you're met with another crisis. What happens if you have a fire in the next 6 to 8 months, wind, rain, earthquake? Our firm does a study of CAFRs throughout California. And in our survey of CAFRs, we know that general fund reserves as of the 2019 CAFRs was about 25% of general fund spending. That means 3 months of expenditures, and that's your unrestricted funds. And I'm going to add on that some of that was being set aside for the increases in pension and OPEB. Breaking point. When you know you cannot pay your debts when they become due, your fixed debts, contractual debts, we know that's your breaking point. If you haven't figured out when that's going to happen, today is a good day to start. If you have an inability to repay internal borrowings before the end of the year, if you borrowed restricted monies from other funds to cover cash deficits, just to be aware, financial officers generally will have an immunity from personal liability unless you have knowing violations of law. And you cannot permit employees to come to work if you know the municipality cannot pay your employees. That generally violates some labor laws in some states. So you got to pink slip your employees. and lay them off if you know you're not going to be able to pay them. And I just want to point out that available cash in some cities is not necessarily fund balance, and your councils may not understand this, or your boards or your commissions. And so getting a good handle on what does available unrestricted cash mean is super important. So I'm going to go through a couple really quickly cash flow models. There's not detail here. I will tell you, keep it simple. Again, so you can explain it to council. I would start with direct entries of expected revenue flow at the expected time of receipt. I put in here a budget. You can see that there are 2 years of actual information as well as a current projection. And then looking at the one important column is ensuring, consider what did your city council, commission, board last review, approve, accept. So what do they know? What have you told them? How well do they understand it is super important. The other is to roll up into categories that either match the adopted budget or the CAFR. And where you need to is to expand revenues in your cash flow model that have multiple revenue drivers and trends. Oftentimes we glom stuff together in one category, but it has different drivers to that revenue model. And so you may need to split some things out, and I'll show you that in a couple of slides. Available fund balance cash depends on the accuracy of prior financial budget information. Audits, you may be waiting for audit entries to cash. Maybe you didn't reconcile timely. And then I think last is track your total use of reserves, and was it for one time, and your ability to replenish it. Many of you have reserve policies that do say when you can use reserves, and so you need to look at your policy. Next slide. At the bottom of this slide, you can see contingency. It could compromise a number of things. You may have lawsuits coming, claims, legal, consulting costs, mission critical spending that you're going to need for the new normal. And if you didn't build that into your budget at the beginning of the year, this is a time to think about it at mid-year as you go forward. Next slide. Again, I'm going to say the model for cash flow doesn't have to be overly complex. The one I presented here is enough to put together a basic cash flow model. But most importantly is to ensure you document your assumptions and validate that those assumptions used are defensible and realistic. I'm going to ask a few questions. I was asked similar questions. When was the projection prepared? Who prepares it? How accurate is the projection compared to any prior period? Did you do it daily? Did you do it monthly, quarterly, annually? Have you ever done it before? How accurate are the numbers underlying it? Do you review it with your city manager and your city council or your boards and commissions? Do you know your cash position? When you look at what your spending was, how did you project what you'd pay 45 days before the end of the year and after year end? And how did you decide which creditors you were going to pay and why? Why did you choose those creditors contractually? Were they contractual? Did you pay them timely? Did you delay payment? Have you canceled contracts or defaulted on any? And why did you choose those over the others? And what analysis did you prepare to decide which contracts and creditors you were going to prepare? So I would say in kind of closing, you need to test your different revenue and or expense scenarios and options to ensure cash flow remains positive if possible. If not, you may need to look at reductions. Often overall reductions of 1%, 5%, and 10% are done across the board, across departments, or you can look at specific reduction options. Areas to look at are listed below: personnel costs, capital spending, materials, advantageous inflows and outflows, and getting new resources. We talked about grants, ISF funds, general fund reserves, taking a look at new resources on cost allocation plans. Possibly you haven't updated one or even looked at one in a while. Now's the time. And looking at various ways to preserve cash during this, deferring maintenance, deferring capital, rethinking your subsidies, looking at software contracts. Maybe you've got multiple software contracts you can consolidate. And so in closing, I know that's a lot to take on. I think essentially you're all well prepared to do these. But if not, one of the things we did is we brought help in to help us look at these and get a second opinion. And I think that's really important as you're going into your next phase of COVID-19. And Ken, I'll turn it over to you to give more good.
Thank you, Vanessa. So now Ken Deeker is going to talk about the possible municipal bond stress and continuing disclosure. As you know, most of our government agencies heavily rely on debt. How's the debt market responded to the COVID-19, and what do we need to be aware as a government agency? Ken, here you go.
All right, well, thank you, Ken, very much. Can you guys hear me okay?
Yes.
Okay, great. Yeah, so essentially for the first 2 or 3 weeks of March, the municipal bond market essentially froze. Essentially what happened was you had a lot of investors panicking, moving money out of the market. So you had a lot of money coming out of the mutual funds. Those mutual funds sold bonds all at the same time into the market, flooding billions of bonds hit the marketplace in a very short period of time, and there were no buyers. Inventory swelled. Deals could essentially not get done. Since that time, the market has slowly reopened, and I say slowly because you're seeing the best rated general obligation bonds for school districts. Not a lot of cities issue GO bonds, and you're seeing some water and sewer, highly rated water and sewer bonds getting done as new public offerings. The commercial banks, who were very active in the direct placement market, also kind of shifted their focus to funding the SBA loans as part of their mandate under the CARES Act. So a lot of the private placement banks have moved out of the marketplace, although some are still active. And you're seeing a few deals getting done. The lesser rated credits, for example, a lot of cities and counties and so on issue CFDs, Mello-Roos bonds, non-rated. There has been no non-rated deals done except one for the Irvine Unified School District that had bond insurance at the tail end on some of the maturities. Other than that, in the middle of May, there are 4 or 5 non-rated deals scheduled to hit the market. We don't know if the buyers will be there. I think a lot of that comes down to whether or not how much developed that district is. So you're seeing a lot of highly rated, these are highly developed districts with good diversification. Those can probably get done. So what does this mean? So I thought I'd move into sort of talking about specific bonds for specific areas of a city or county. The general fund, obviously, as Vanessa was pointing out in her presentation, there were significant and immediate reductions of sales tax revenues, transit occupancy tax, impact fees, facility usage, for example, golf courses, parking facilities, those sorts of things. You have a possible significant reduction in assessed values. And Vanessa addressed this a little bit. There is a lagging indicator there. I got off the phone this morning with some consultants in here in Northern California who do appraisals and absorption studies, and they're kind of seeing a mixed picture right now. They are saying that home sales are moving, albeit slowly. They are closing contracts on a higher percentage of those people that are coming into the market. So somebody who's really interested in buying a house is actually going out and looking at models and looking at the homes. Those that were kind of iffy, just thinking they were doing it, aren't coming out. So they're closing contracts on a higher percentage. However, that does put potential future stress on assessed values and a further reduction in property taxes, probably in the 2022 timeframe. The other thing that's really concerning, and I know everyone's been talking about this for a number of years, and we obviously had to deal with it in the Stockton bankruptcy. There were significant CalPERS losses in the investment portfolio in March. They lost $69 billion on a $400 billion portfolio. Those losses are going to need to be re-amortized. And I have one, and I know several of my agencies have been looking at these stresses for quite a while. I've always been recommending that each of them do a long-range financial plan. In Stockton, we had a 30-year plan, and we had to do a 30-year plan because we were cutting deals that were 30, 40 years long with the various creditors. In San Bernardino, it was more of a 20-year model, but again, they were complicated models because we had to prove to the courts that these were valid instruments. But however, and as Vanessa said, they don't need to be as complicated, but you need to factor in these increases in your unfunded liabilities. And for one public agency, I know their payments were going to go up $1 million a year starting in 2022, and an additional $5 million a year by 2027, just based on the most recent losses. My biggest concern is, where is CalPERS going to get a 7% return? You've got fixed income investments at near zero. You've got a stock market that is being really kind of held up right now by all of the fiscal measures being done by the Federal Reserve and the federal government. And people are projecting a potential downturn in the stock market. As a matter of fact, it's down about 2.5% today. And the real estate market, if there's a softening in real estate. So those are the prime areas where PERS funds it. So it's unlikely any time in the near future that they're going to get anywhere close to the 7%, putting further stress on the general fund. Enterprise funds, there's obviously been a utility billing holiday with the no shutoff enforcement for residential. There's been a significant reduction in commercial usage. There's a lack of new connections and impact fees related to the enterprise funds. And again, if you have a golf course enterprise fund or a parking facility, you've seen a significant reduction in those revenues. And again, as mentioned on successor agency transactions, you could see a possible significant reduction in assessed values and decrease in future tax increment at some future date. Next slide, please. So examples of obligations for the general fund. You'd have lease revenue bonds, certificates of participation, municipal leases for fire and police vehicles, computer equipment, or energy improvements. What are the events of default? Obviously, the first one is a payment default, but you could have a breach of covenants within the document even before there's a payment default. You could abandon the use of a leased asset if it's damaged or put out of service, or ultimately, like in the Stockton situation, the declaration of bankruptcy. So what are the remedies available to those investors? There's a possible change in interest rate on direct placements or variable rate demand obligations to a default rate. We had one variable rate demand obligation in Stockton that was averaging about 25 to 50 basis points was the annual interest rate. It went to 6%. Generally, under leases, you cannot accelerate those leases. They do have the power of mandamus or other action of proceeding to enforce the rights of the bondholders. As was the case in Stockton and the parking facilities, the investors did take possessory interest of those leased assets and operated them for the benefits of the bondholders. They were not able to operate those facilities to make full payments, but they were able to take over and put them under management to achieve as many dollars as they could. And they can relet the leased asset if it's possible. Enterprise fund obligations, water, wastewater revenue bonds, the most common. You could also have low interest rate loan programs, SRF, USDA, iBank, and WIFIA. Parking revenues, that's one that I just had a conference call on yesterday regarding a parking authority that's seen a significant reduction in parking revenues, particularly related to events. The downtown events aren't happening. Some office and local government are still operating, so there is some parking meter revenue coming in, but again, significant reductions. Municipal leases, for example, for energy improvements. And those would be energy improvements for water, wastewater type facilities. If you fall out of your rate covenant, the documents generally require the issuer to raise rates and charges to maintain the covenant. You may or may not be able to do that. Obviously requires a Prop 218 process, which is time consuming. And it may or may not be material to report the significant event depending on non-payment risk. So you can technically fall out of your covenant, but as long as you're going to continue to make the payments. One of the things that some people have is the ability to use a rate stabilization fund. So you may want to consider depositing dollars to that rate stabilization fund in order to maintain coverage during the period of stress. But again, you may or may not need to report it depending on whether it's payment risk. Possible, the remedies, again, possible change to a default rate on VRDOs, commercial paper obligations. There could be a possible acceleration. Again, it depends greatly upon how the documents were drafted. And they do have mandamus powers to enforce the rights of bondholders for repayment. Next slide. Successor agency obligations. These would be tax allocation bonds or other ROPS payments that are due, including a lot of cities have made internal loans to the RDAs when they were originally formed. Those could be at risk. Unfortunately, if you fall out of your debt service coverage, you have a lack of control. You can't raise rates and charges and really have no power. So it really becomes an issue of being able to notify the street of possible payment disruptions. Remedies, possible change in interest rates on direct placements. You see a lot of direct placements were done There are default rates in those direct placement documents for successor agencies. You need to figure out what those are and make sure they get onto your ROPS. There could be possible acceleration provisions. The nice thing is that any shortfall amounts can be included in future ROPS, so you're going to need to manage that. So annual continuing disclosure. Again, the MSRB, which is the Municipal Securities Rulemaking Board, and the SEC have provided guidance. There is no extension of a time frame for filing annual continuing disclosure. So what you have to do is you have to post all the data that you have available. For example, unaudited financials are acceptable. We've already gone by most of the continuing disclosure deadlines, which generally fall on March 31st. If you have not yet filed, you need to file a notice of failure to file and file whatever audited or unaudited financials you have to date, and they can certainly be swapped out when the audits become available. On direct and private placements, you must file related documents on any direct placement or private placement entered into after February of 2019. They want the marketplace to understand, because a lot of these were not being reported to EMA. Some people argue that it's only for those obligations where you have a reporting requirement. For example, I have one client that issued lease revenue bonds to build a fire station, and they entered into an energy improvement lease that was also paid for through the general fund. That obligation, the publicly offered bonds that were done last year, had a continuing disclosure requirement. Therefore, you must file the paperwork related to the direct placement that the city entered into. Some argue that you must file the documents for all direct and private placements if you have any continuing disclosure agreement. For example, if you have a general fund publicly offered bonds that has a continuing disclosure agreement, and you enter into a direct or private placement for your water and sewer improvements, even though they're paid from different sources and not directly related to each other, some are arguing that you must still file the paperwork and notify the street of that direct placement. Next slide. Okay, so let's talk about sort of the things that create material events. First of all, if there's a principal and interest payment delinquency, if there's an unscheduled draw on a reserve fund, either whether it's funded by a surety or a cash funded reserve fund for the bonds, an unscheduled draw on credit enhancement, if you substitute a credit or liquidity provider, if there's a defeasance, if there's a rating change, and this could hold true for insurer rating changes as well, because during the Great Recession, a number of the insurers actually went below investment grade and several of them disappeared. And a lot of times that didn't get communicated to the street. Adverse tax opinions, a tender offer for bonds. A big one is bankruptcy, insolvency, receivership, or a similar event. During the Stockton bankruptcy, and Vanessa can attest to this, we filed thousands and thousands of pages of material event notices related to the bankruptcy leading up to and throughout the event. If there's there was a couple of, one thing I want to point out, there was a couple of additional items that were added recently. And again, this gets back to the concept of direct and private placements. If you default, or there's an event of acceleration, a termination event, or modification of terms of any financial obligation that reflects financial difficulties, you must file a material event notice. That's critical as you guys begin to realize the cash shortfalls that are coming. You also need to report obligations if they are material. For example, an IRS notice regarding possible change to tax status, non-payment related defaults, a bond call, modification to the rights of bondholders, release, substitution, or sale of property securing repayment of an obligation, merger, consolidation, or acquisition involving the issuer or the sale of all or substantially all of the assets, an appointment of a successor or additional trustee. And the big one here is incurrence of a financial obligation, any of which affect holder of the bonds. So that one right there is what's causing us to have to file for direct placements. If you have any continuing disclosure agreement outstanding for any publicly offered bond, you need to file a notice of any direct or private placements after February of 2019. Okay, so Vanessa talked about this a little bit in her portion of the presentation, but I wanted to kind of give you the background as to why this is. The debt limit in the California Constitution, which is Article 16, Section 18 of the state constitution, California public agencies can only borrow with 2/3 vote of the electorate with the following exceptions. The Offner-Dean lease exception, which allows a public agency to enter lease revenue bonds or certificates of participation or municipal leases. There's a special fund doctrine, which allows you to do water and sewer obligations, enter into those obligations because, again, you're going through a Prop 218 rate setting process and obligations imposed by law. And that's the exception that people use to issue pension bonds. You file a validation action, essentially suing yourself. And if the court finds in favor, then you can move forward on issuing pension bonds. And if there's a judgment against the public agency, you do not have to go to a vote of the electorate. But where Vanessa touched on this, and I want to make it very clear, public agencies can borrow from pool cash to fund operations during the fiscal year, but must repay by revenues recognized during that same fiscal year. So you can borrow from pool cash to meet operations during the course of the fiscal year, but you have to be able to repay it. And as Vanessa knows, leading up to the Stockton bankruptcy, the city knew that if they did not default on payments March 1st of 2012, that they would not have enough cash to make payroll and all the obligations of the general fund through the end of the fiscal year. And that's when the city entered into confidential mediation with its creditors prior to the filing of bankruptcy. Unfortunately, you do not have any authority to lend these restricted funds to the general fund. So you have no authority to borrow or loan money from the water and sewer funds to the general fund. This could lead to a possible 218 action. And if you knowingly do this, could lead to some liability for your officers. This is often something that cities do during a time of fiscal stress. And the bankruptcy team in Stockton could not figure out how several other agencies, given their fiscal condition, did not file for bankruptcy. And we suspect that many of them tapped into water and sewer funds and created this impermissible debt that cannot be done. The general fund obviously is unrestricted and can loan to any other funds, but unfortunately during times of crisis, the general fund is really the one that suffers the most given the lack of sales tax, TOT, AAVs, and so on that we're expected to experience. So with that, I'll turn it back over to Ken.
Thank you, Ken, for very informative information about the bond market. So our next speaker is Jeff Chang from Best and Krieger. How about like the CARES Act? How's that going to impact the retirement plans for these government agencies?
Good morning, everybody. Can you hear me okay?
Yes.
Before I get started, and I'd appreciate a little bit of guidance from you, Ken, I want to be very respectful to the importance of the open forum piece of this. So when would you like me to conclude my remarks so that we have an open forum?
You know what? I think we can keep going, and then we'll still have the open remarks at the end.
So what, 15 minutes?
15 minutes.
Okay, good. Thank you very much. First slide, please. Next. Okay, so basically I understand, and I've spoken with Poon Group, and I really appreciate this opportunity. I recognize that I'm talking to an audience that's primarily members of the financial staff of cities and special districts. I also know that many of you have either direct or indirect interest, responsibility, and personal involvement with the benefits that your city or special district offers. I also know that you, because of your position, you have the ear of the HR department in your cities and special districts. And so what I would ask you to do is recognize that some of the topics I'm going to cover very briefly today are hybrid, and they cross over between finance and human resources. Many of you might feel that they're predominantly human resources, but I would ask that you take notes, take note of what I'm saying, and to the extent you find it useful or provocative, please share it with the human resource people that you work with, because it's really important for our municipal and special district clients to understand some of these issues. Given the time constraints that I'm dealing with, I'm going to do a very high level kind of overview of these different things that are listed on this first slide. And so don't expect a lot of details, but what I'm going to really try to focus on are some of the compliance issues and gotchas involved in these various topics. In other words, I'm not going to so much reiterate all of the detailed rules, but rather warn you and your colleagues about some of the gotchas or problems with implementing or complying with some of these rules. Because of the, if you will, restriction in time, I've provided my contact information, my phone number, my email at the end of the presentation, and I would invite or welcome questions or calls from you. At this stage, we're all trying to help one another, and so if you or your colleagues have any questions about any of the materials I'm listing here that I will cover or maybe miss covering, just give me a call or send me an email. Okay, next slide, please. So what I'm going to do is I am not going to read in detail all of the CARES Act changes, but I'm going to explain that either you or the Human Resource Department in your agency has already received numerous notifications from your retirement plan vendors. That is the people that provide you with your 457B plan services, your 401A plan services. That would be ICMA, Nationwide, Lincoln, Voya, VALIC, CalPERS, Empower. Those kinds of agencies throughout the month of March have already been sending out packages, I think predominantly to the HR staff, notifying them of the CARES Act changes, what they are, and providing those people with election forms to be completed, basically asking those people, do you want to implement the CARES Act changes that I'm going to be describing here? So on the first slide, I've mentioned the first of 3 major CARES Act changes that are of interest. I call them, the first one, coronavirus-related distributions. And I've explained on that first slide basically what they are. And I'm not going to go through a lot of detail in terms of reading that to you, but I would point out to you that the definition of a CRD is actually longer than what I've listed on the bullet point, and it's very detailed, and it's important that the plan and plan administrator follow that definition, because if you don't, you potentially create a problem for your plan, i.e. you would be making a distribution that is not authorized by the law or your plan. Okay, next slide, please. I think one of the important things for financial people and you as individuals to know is that coronavirus-related distributions are available for very special tax treatment. That's why there's so much interest in them. The first thing to note is they're not subject, whether they come out of a 457B or a 401A plan, they are not subject to the standard 10% and then 2.5% state early withdrawal excise tax that generally applies to early distributions from these kinds of plans or IRAs prior to the age of 59.5. So that doesn't apply. Secondly, the CARES Act provides that the income tax on these distributions, and these are taxable distributions, can be spread over 3 years. Okay, I think that's optional, but the default is that the income tax payment can be spread over 3 years, and we'll be waiting for information from the IRS as to how that is reported and filed. The next thing is that these distributions, if they're identified as CRDs, are not subject to the standard mandatory tax withholding when they're taken out. Because as you may know, most so-called partial or lump sum distributions are subject to a mandatory income tax withholding upon withdrawal. These are exempt as long as they are CRDs. And I guess one thing I'll mention is that whether something is technically a CRD, in other words, whether it meets those requirements of being coronavirus related, is something that the individual can certify and that the agency can rely on that certification as to the cause, not as to the amount. The final tax advantage is, and this is very important, although complicated, is that let's say you take out a $100,000 CRD this year, 2020, you may recontribute that $100,000 into an eligible plan within 3 years of the distribution kind of as a rollover without application of the regular contribution limits. So for example, if you're subject to a $19,500 457 deferral limit and you took out a CRD of $100,000 this year, you can, if you can afford it, you can put back, you can contribute the regular $19,500 and put in another $100,000 back into that plan or other eligible plans without regard to the contribution limit. So basically you can restore these amounts, although the amounts you've taken out as a CRD are taxable. Next slide, please. The second major change I wanted to mention has to do with participant loan relief. And these only pertain to plans that allow participant loans, and you are not required to permit participant loans if you do not already have them in your plans. With that said, if your plan, your 457 plan or your 401A plan doesn't allow loans, but you want to provide this kind of CARES Act relief, you can amend your plan now or later this year to permit participant loans and alongside that, provide these CARES Act participant loan relief provisions. The major things, there are basically two types of relief. One is that the standard participant loan limit, which is normally the 50% of your vested account balance or $50,000, has now been increased during this window period from March of 2020 to September of 2020. If you have a coronavirus related event and you're a qualified individual, that loan limit is now increased to $100,000 or 100% of your vested account balance. And that is taking into account any outstanding loans that you have during the previous 12 months. That limit, that $100,000 or 100%, is also based on an aggregate of all plans that you currently are borrowing from or could borrow from. So for example, you can't take two $100,000 loans, one from your 457 plan and one from your 401A plan. All of the plans of your employer have to be aggregated for that purpose. The second bit of participant loan relief has to do with an extension of the repayment terms for any what we call CARES Act qualifying loans. And basically what they're saying is if you had an outstanding participant loan as of March 27th of 20, even if it originated last year prior to the COVID-19 pandemic, you still have the ability, and it's basically automatic, for an extension of any payment date between March 27th of 2020 and the end of this year to be automatically extended 1 year. So in other words, if you had a payment due date under an outstanding loan or a new loan during this time period that would be, say, due on May 1st of 2020, that would automatically be kicked out 1 year, and you would have one additional year for those repayment provisions. And so theoretically, if you were in the 5th year of a 5-year loan, that would actually extend the loan to 6 years. Next slide, please. The third area is a little bit less of a sponsor issue, but it really is important for you to be aware of, both as participants, also just to help out your coworkers and your older employees and maybe people who have terminated but who have left their money with your plan. And that is, for the year 2020, the CARES Act has suspended what are called required minimum distributions. Those are the distributions that most of you are familiar with that you must commence after you turn, it used to be 70 and a half, and under the Secure Act, that's now changing to after you turn 72. But either way, if you or somebody you know was required to receive a required minimum distribution under one of these rules during the year 2020, all RMDs from defined contribution plans, 403Bs and governmental 457s, not from defined benefit plans, okay? Just from defined contribution plans. All of the RMDs from those kinds of plans are waived, and that is automatic. So basically, there are no RMDs from those plans for this year. So the point at the bottom, the third bullet point that I want to make, is what happens if someone was either planning on or counting on getting an RMD and they had factored that into their cash flow or financial planning. I would argue that if the only reason that they were going to get that payment was because it was a required payment, then the vendor, the payer, the plan would not make the payment. And probably there's a need to reach out to those kinds of people and say, do you still want to receive some other payment? Okay. So again, this is something where employers might want to or need to reach out to their older, perhaps terminated or perhaps not terminated participants to see if they were counting on getting these amounts of money, because a lot of vendors are simply not going to make those payments if all they were required payments. Okay. If you have questions about that, you can ask. Next slide, please. So this is really important. These next couple of slides are really critical. We get lots of questions about whether these 3 CARES Act changes are optional or automatic. And I think you need to know, and the HR people need to know, that cities, special districts are not required to offer or permit CRDs. In other words, you don't have to do anything with your plan to make these specially available under your plans. If it's too administratively burdensome on you or you can't comply, et cetera, you don't have to do this. Clearly, you might want to if you're getting requests for them and your workforce is in need, but you don't have to. It's optional. The second thing that is not required is you do not have to offer new loans or make new loans or additional loans available if you don't wish to or if they're not provided for in your plan. And what I meant by additional loans is that many plans basically allow loans, but they only allow under their policies or their plan terms, they only allow one loan out at a time. If your policies or your plan says only one participant loan out at a time, and there's already an outstanding loan, then even if you wanted to make an additional CARES Act loan or a larger loan, you couldn't unless you would extend or change your policy or your plan terms. You are not required to do this, but you can. So that's something, again, you have to think about whether you want to do this, whether you can do this. What are automatic? Well, what are automatic are definitional things, I think. First of all, a CRD is a CRD is a CRD, meaning if you received a distribution, say earlier in 2020, it could have been an unforeseeable hardship distribution under the old rules. If that distribution qualifies as a CRD, our belief is that it is a CRD and it will and should receive favorable tax treatment, okay? So there's a reclassification or recharacterization issue that you might need to research or consider. The 1-year loan repayment extension for all outstanding loans as of 3/27 appears to be automatic. And so what that means is that you and HR need to coordinate with your various vendors, custodians, trustees to keep track of these extended payment due dates so that you do not inadvertently treat outstanding loans as in default, okay? The third thing that's automatic, as I mentioned, are the RMDs. They just are, and so you have to deal with those and let people know. Next slide, please. Basically, what I'm going to tell you here is rather than go through all of the details, I would like to direct you to my blog, which I published about 2 weeks ago, and it basically highlights all of the problems that you and HR need to think about if you're going to implement these things. But the things that I think are really important, I'll just mention 2. Number 1, any change in benefits, whether it's favorable or not, is likely subject to meet and confer. That's the third bullet. Have you done this? Are you going to do this? And then the second and third thing that I want to highlight is the fact that most of these notices and checkbox elections are going to mid-level managers and HR, and it's asking those people to check the box and send them back. Those checkbox elections are actually amending your plans. And I would argue that most mid-level HR people, maybe even the HR director, do not have the authority to amend the terms of your plan that way. And so I think your vendors may be misleading you as to who has authority to do this and make these changes. The other thing is that most of your plans say that in order for the terms to be amended, the plan needs to, the amendment needs to be taken perhaps to the city council or to the district board. And so I would just suggest to you that implementing some of these changes, while not impossible, may require steps that you haven't gone through yet that you might want to talk to council about. Next slide, please. The next thing I wanted to highlight, and I just posted a blog this week, which is linked at the bottom, so I'm just going to summarize this, is just simply, I noticed there's been a lot of talk about furloughs versus layoffs. And the comment that I would make is that a furlough, as we understand it, contemplates a basically reinstatement or coming back to work, whereas most layoffs are more or less not necessarily intention of coming back to work. And so take a look at the blog, because if you have a furlough where there's an understanding that the person may be recalled, you may not necessarily have a distributable event, and you have to be careful about paying those people out. Next slide, please. I've highlighted here, and I think most of you are aware of this, if you're utilizing retired annuitants from CalPERS, there's been guidance coming out of the governor's office as part of their state of emergency declaration and further guidance, basically suspending some of the retired annuitant work hour limitations and the 180-day break in service rule. So if you have retired annuitants, please take a look at that, but understand that this guidance and these lifting of these rules do not apply to violations that may have started or occurred last year. So just keep that in mind. Next slide. This slide is actually something we could spend a whole session on, and I appreciate what Vanessa and Ken said about hard times. What I've done is I've thrown up some bullet points for you to muddle over and look at things that I think might be a little bit easier. They don't involve CalPERS generally, but things that cities and special districts can look at, think about, consider doing, talk to their unions about if they need to, but make changes potentially that will save cash, okay, now. And so I'd ask you to take a look at these lists. If you want to talk about them further, I'd be happy to address those concerns or address them during the open forum. Next slide. The final thing I just wanted to bring to your attention, and you may not be planned fiduciaries, or you may, are the fact that the pandemic and the crash in the stock market, the volatility in the stock market, has highlighted two really important things to me. Number one, and the subject of most of these links, is the fact that you've got many employees investing in target date funds or investment vehicles that frankly were much more aggressively structured and allocated towards stock than anybody realized. And so there are a lot of target date funds out there, including one that I'm familiar with that had a target date, a retirement date of 2020 this year. And when I took a good look at it, it was in my company's plan, it had 50% in stocks, okay? So there's a lot of exposure to volatility there. And I'm just saying there are a lot of target date funds that operate that way. And if you're a fiduciary, you ought to look at that. The other fiduciary matter that I'll end on is the fact that a lot of you, particularly the finance officers, have set up OPEB and CalPERS pension stabilization trusts, 115 trusts. And I've been writing about this for a couple of years. I have a grave concern that a lot of those trusts were very aggressively invested. They might have been in 50-50 or 60-40 portfolios. And I think the real question is, where do those stand financially, investment-wise, and how do they fit into your budgetary strategies and plans to basically pay your CalPERS obligations within the next 5 years or so? You might want to revisit the way those are invested. Ken, next slide. I think that's basically it. So I'm going to close there and turn it back to Ken. Thank you.
Thank you, Jeff. So the next session is open forum, and sorry for taking a little longer. Within the last 2 hours, I think we cover everything. But the next session here is really, really important and interesting because I do have two of my clients willing to share what do they do actually at their organization. So I do have about like 4 questions here. We can pretty much go into it very quickly. So I do have Onyx Jones from City of Culver City, and then also Kim Thorner from Olivenhain here to answer these questions. So the first questions here is, how's your organization execute the business continuity plan? So maybe we can start up with Kim.
Sure. Thank you, Ken. Can you hear me?
Yes.
Okay, fantastic. First, I want to thank you. This has been a fantastic webinar. I actually learned a lot. I'm probably going to incorporate some of it in our future plans. But here at Olivenhain, we are an enterprise fund, water, wastewater, parks, and rec. So one of the first things I did was declare an emergency back in early March, and I do present to my board monthly on that emergency, but that allowed me to change work schedules, order parts, equipment, and supplies. And we were fortunate that we do have a business continuity plan. It included a pandemic response plan. And so I think we did what most public agencies did. We did the social distancing, the telecommuting as fast as we could, closed the front lobby. Everything was that we did was focused on protecting our staff and maintaining our service level to our customers. And that included me modifying work schedules of employees and doing what we called shelving and preserving key critical functions, maintaining our water treatment plant, maintaining our system. We divided into almost like 2 separate entities and had employees working on different weeks actually, and those employees that weren't working were shelved and preserved just in case the pandemic did spread. We were able to continue to provide the service. I think 2 of the things that we did that I thought were maybe unique, the very first day I declared the emergency back in March, I asked my staff to go through what their critical supplies, parts, and materials were, and we normally have about 3 months on hand. I asked them to order an additional 6 months so that we actually physically had those supplies, chemicals, especially for our water treatment on hand. We also created a work order very early on to track all of this, not just for our auditors, but also with our intent to apply for any of these additional costs above and beyond to FEMA. And then I think the most difficult thing that we had early on was ordering laptops and getting them deployed within the first week of declaring the emergency so that our staff could work remotely. But so far, things are going well.
Great. Thank you, Kim. And how about Onyx?
Thank you, Ken. I appreciate being here. Can you hear me?
Yes.
Okay, great. Much like Kim, when March came around and it became obvious that COVID was going to become a significant problem, our city manager also implemented the EOC. He became lead and he issued some orders within our city as well. We also had to do a modified work schedule. We worked with IT to implement laptops and computers so that people could work from home. But we also implemented a lot of cross-training, not just within our department, because there are essential services. I work with finance. There are essential services that must go on, regardless of whether people are sick or people are at the office. We still have to pay bills. We still have to make payroll. So we did a lot of cross-training within the department, but then we also had an opportunity to cross-train outside of the department because there were many employees, specifically part-time employees, who worked in other departments such as Parks and Rec, who suddenly found themselves without anything to do because we had the shutdown. And so they were then moved into other areas that were needed, that were more essential services. So some of them were moved over to purchasing and help with ordering and supplies and delivering of supplies. So really a citywide effort. And so we collected specific needs throughout the city and just redistributed employees as needed. And then the online services, the technology of today is awesome. It's wonderful. And so it was a progression of transitioning many of the services that we typically would offer at the counter, offering them online. Initially, we did have to address the public. They were still coming into our office before the shutdown was actually issued. So we put procedures into place that I know we'll use once the stay home order is lifted. And so the wiping down of the counters and just being safe within the department, face masks, gloves, things of that nature are all important to think of when you start opening up to the public and have people come into the counter every day. So those were a lot of the things that that we did, and we did a formal telecommuting agreement as well, so that employees were aware of what they were to work on while they were away from the office.
Great, thank you. So the next questions here is when employees are working remotely, as you know, the security, like the data security is very important nowadays. And do you guys actually increase in any like security measures over the cyber environment? Kim?
Yes, so we actually had an experience about 6 years ago with a cybersecurity incident that we actually had reviewed by Homeland Security and FBI. So our IT department takes this very seriously, and they were very cautious when we started deploying employees remotely. We made the decision not to allow any personal devices to be used by employees. That is a standard practice already. Which meant my IT department had to deploy about 40 different devices, cell phones that had the capability to connect to laptops and the laptops. So we did not allow employees, even though we sent almost everybody to remote work, to utilize personal devices. We actually deployed domain joined laptops. The employees have the exact same network policies as though they were still in the office. We did implement two-factor authentication in order to connect to the district system, the VPN. And we also, the IT department took the extra step to put those VPN users on a separate network from our enterprise network. We learned that, you know, hackers like to get in and figure out and stay on that network, but we'll separate them. The IT department also simultaneously deployed a new antivirus, a next-gen antivirus. And then we started increasing our phishing tests. We actually send out fake emails to employees to see if they'll click on a link. And if they do, they get remedial training so that it doesn't happen again. We're actually quite pleased with how that's going. And then finally, the IT staff also has laptops, and they can remotely from their own homes support the end users who are at their homes because they have network control and access. So a lot of extra security, but we did choose to keep it on our system and not allow that mix of private devices.
Great. How about Onyx at Culver City?
Very similar to what Kim shared and expressed. Our IT department has done the same. They do actively monitor all the logins that come in through the VPN network. They look for any anomalies, strange things like someone logging in from France, you know, look for red flags. So they do monitor that more closely than they have ever in the past. And the other program that we have similar to Kim's that I think has been very effective, so I agree with her as well, are the cyber training modules that all the staff are required to take. And then there are these fake phishing emails that go up. And if an employee fails because they click on the phishing email, they have to retake the training. And the department heads are notified on which employees are repeated offenders, I should say. And so that helps us have open dialogue and communication with them, because we then have to sit down with them and make them really aware that, you know, we really are monitoring what you're doing here in the office, and you have to heighten your awareness with these emails, because as you know, some of the emails come in and they look very legitimate and you're very easily tricked. And we had an experience with that where someone posed themselves as the mayor and reached out to our payroll department. So it's something that you just have to be diligent and aware of, because those phishing emails come in now more frequently than ever.
Yeah, great. The next questions here, now I'm having Onyx to answer this first. And how does the organization handle your investment portfolio in minimizing loss from this volatile market?
So of course, hindsight is 2020. And so one would say that the best thing to do in a time like this is make sure that you're not heavily invested in international or corporate investments, especially with OPEB and pension, as Jeff pointed out. Fortunately, our city manager, before the market really tanked, was very leery because there was talk of a recession. And so for our city's portfolio itself, we got rid of a lot of our corporate bonds, and we were down to only about 13% of corporate bonds. So that has helped. We also typically monitor our cash on a quarterly basis, and we do our analysis. Well, now we're going to increase that to monthly so that we can manage the cash balances. We also am looking at, with everything going on and the fact that revenues are way down, we're going to need more cash up front. We're going to need it handy. So we're keeping cash balances more liquid than in the past. We do utilize LAIF as well. And we also want to make sure that council is constantly aware also of where we are in our cash position, because this is really key. I think it was Vanessa who highlighted fund balance is one conversation, but your actual cash balance is different. And so that has to be managed during this time. And it definitely has to be a position where you protect that asset as much as possible. And for the investments that are in our pension and our OPEB, we have taken some losses. So that's something that really has to be reviewed. And we get notifications when some of the rating agencies drop the ratings on some of the investments we have. So those decisions have to be made right away. And we work with our investment advisors quite frequently as well to make sure that if we do need to make shifts, that we do that in a timely fashion.
So how about Kim?
Sure. I thought it was funny that you started off with hindsight's 2020, and we were saying the same thing, in that we learned from the 2009 recession. So at OMWD, we have an investment policy. It's adopted by our board. We update it annually, but the goal of that investment policy is the safety of the principal. That's the number one goal. And so we do invest with that number one target in mind. We've been keeping the duration of our portfolio very short, actually, in the 2 to 3 year range. I think we're fortunate in that about 60% of our investments are cash or market securities like LAIF and CAMP. And we do have, very similar to what Onyx said, only about 10% of our investments in muni bonds and commercial paper. Our finance department has started updating the frequency of the cash flow reports to weekly right now. And so we are increasing that duration. But I identified with Vanessa because when she spoke, because one of the very first things my finance officer came in and told me is cash is king. And so we're trying to maintain our liquidity, but we're fortunate that the policy that we had already did have us in a good position, heavy in cash and market securities.
Great suggestion here. And last questions here is, how does the organization foresee its cash flow for the next couple months and dealing with the potential revenue shortfall? I think at the city, of course, like at the city, you probably have like all kinds of revenue compared to a water district. You're dealing with like fee for services. Onyx, like how are you going to deal with the current cash flow?
Well, first we had to do a real honest assessment of our projected revenues. And as other panelists have indicated, we really can't look in our crystal ball and see where this will end. And so we don't know how significant the impact is going to be. So the city manager and I set out with running various forecast scenarios We do have a 10-year long-range financial plan program that we use. It's very dynamic because you can change different scenarios or estimates for various revenue sources. All the revenue sources that were highlighted in the presentation are all, unfortunately, significant revenue sources for the city of Culver City. Sales tax, GUT, business license, TOT, charge for services. All of those are being impacted right now with COVID. And so there's a two-prong approach. One is to really look for revenue strategies. What other untapped revenue sources are out there that we can help with? We've even had some conversations with some business community members as well. And what things can we offer businesses that may not be financial, but maybe things we can do through development services and planning, you know, for parking ratios or other requirements that they have, where we can be a little lenient with some of the requirements to help incentivize businesses and help them kind of get back into business sooner rather than later. Obviously, when you run a 10-year forecast scenario and you change one factor, say it's the return of the revenues to their pre-COVID levels, if it takes 3 years versus 5 years, has a huge, significant millions of dollar impact on your forecast. And so we really want to try to shorten the curve for the revenues. Some of it we can control, but other things we cannot control. Is totally out of our hands. And so on the expenditure side, the other prong of the approach is to really manage our expenditures. And so we've looked at only budgeting for essential services, cutting out a lot of services that were extra. They were nice to have, but they weren't essential. I absolutely looked at hiring freezes right away and attrition, because those are the easiest to implement with staff. It's hard to freeze the position, but it's harder to actually do layoffs and furloughs. And so we did look at that. One significant thing that the city did that put about $9 million back into the general fund was we just canceled CIP projects. We went through a huge list of CIP projects, and we came up with $9 million worth of projects that could be put off into the future. And so for today, they're canceled. As our resources go back up in the future, we can add those programs back in. And as well as also deferred maintenance. We also looked at our internal service funds, and if they had some fund balance that was available, maybe we were able to reduce the annual transfer to the general fund for that year to help with those costs. We looked at things like purchasing of new vehicles and our vehicle replacement fund. And we just really started getting bare bones with our budget next year, because we had millions and millions of dollars to cut from our budget. And there was discussion about the interfund loans. I think for Culver City, fortunately, that is not an option that we will have to resort to, at least not in the short-term basis. We do have pretty healthy reserves, but when we look at our forecast scenarios, those reserves, which are about 67% or so, could very easily get eaten up within a 3-year period if we're not smart about how we plan and adjust. So where before we had this forecast and we said, this is the way things are, now we have more of a fluid forecast that has scenario A, B, and C. And so we have to just be prepared for either scenario and be ready to react and ready to make cuts for either scenario, depending on the next, I would say 60 to 90 days ahead of us will obviously give us more information as we go along.
Sure, it is great that you create like couple scenario dealing with the different situation instead of just having one scenario there. I think this is a great idea. How about Kim?
Very, very similar. We, as an enterprise entity, and our source of revenue clearly is our bills from our customers, and then also property tax revenues. We're running different scenarios on both of those. We haven't yet seen the uptick much. We just checked with finance. You know, we sent out bills April 1st. 5% of those bills, roughly 5%, have not yet been paid, which I don't think is that significant. I think it's, you know, the start of what is yet to come. We're a little bit bound. I think one of the speakers mentioned that we can't do shutoffs anymore. We had already waived shutoffs before the governor declared that, but we're not charging delinquent fees, and we're not doing shutoffs of customers. Normally we would see about 30 shutoffs in a month that we would be eligible. Right now there would probably be about 100, so we are seeing a tripling there. So I think this is just foretelling of what's to come. On the property tax revenues, at least for this last installment, 91% of the property tax payers in San Diego County did pay their property tax. So we're actually looking at a cut as far as what we think our income is going to be on property taxes. We're going to see a cut in delinquent fees. The inability to shut customers off is also going to hit us. We will, I think, eventually use, I think it was Vanessa suggested, the lien opportunity, but the income will be deferred. And so we had just prepared a budget. We're going into a 2-year budget, and we prepared a 3% increase back in February. We're getting ready to present that to the board, and we've revised that. We have a couple options for them, a 0% increase, and then also a 5% cut from the last year. The things that we're looking to do, normal budget cuts that just right off the top, no more seminars, travel, those are easy. We also did a hiring freeze, keeping 2 positions vacant. Also cutting out our temporary labor, cutting out a lot of the consultant work and transitioning a lot of that into in-house work. We plan on utilizing reserves to cover revenue shortfalls. So it'll be a combination of updating our forecasts on the daily as information comes in, doing some pretty strict budget cuts on our end and tightening our belt. I think what we're anticipating, though, is a lot of decline in water sales in agricultural, commercial, and industrial. For our agency, about 70% of our water sales are residential, and so that does give us a little bit of a comfort, at least immediately, that the residential water use still happens. The question then is the capability of those customers to pay their bills. Our customer service department has been very progressive in working out payment terms with customers who do want to pay. So we are seeing some folks agreeing to extended payment terms to help them with that. But it's the same exact thing. We're going to constantly revise our forecasts, not just for the short term, but for the long term, because we do think this is going on for a significant amount of time, and then tighten our belts internally so that the burden does not fall to our customers.
Great. It is a really great suggestion, and the last 30 minutes additional is really well spent. And first of all, again, thank you so much for all the speakers here and then all of our attendees willing to spend the last 2.5 hours with us here. And in dealing with the COVID-19, we are standby here for you. So in case you have any questions, feel free to reach out to any of us. And have since today is Friday, May 1st, hope everyone's great, stay safe, and have a great weekend. Thank you so much.